Hi, good afternoon, everyone. I'm Ting, and thank you so much for being here today. It's been an interesting week in the equity markets, to say the least. I got off a flight from Singapore to Hong Kong on Monday. And by the time I got off, Hang Seng was down 13%. I woke up this morning, and Nasdaq was up 12%. I mean, the tariff whiplash has really sent markets into a tailspin. Even Goldman has rescinded its recession forecast. And so I'm sure everyone here today is very excited to hear our panelists share their thoughts on the equity market's outlook, as well as how to navigate this volatility. So let me pass it to them first to give a quick introduction of themselves, starting with Ioannis.
Hello, it's a pleasure to be here with you today. My name is Ioannis Baltopoulos. I've been in the industry for 15 years. I've been with Acadian for the last 8 years. Acadian is a systematic manager, and I look after our multi-strat hedge fund within Acadian.
Moving on to Gregoire.
Hi, good afternoon, everyone. Pleasure to be here as well. I'm part of Amundi, and I've been with Amundi actually as of today for 23 years. And I'm the investment specialist in Asia for all our US-based investment strategies.
Thank you. And Andrew?
Hi, good afternoon. Just want to first say that it's a great pleasure to be here. I'm Andrew Lee from Capital Group. I'm an investment director. I've been with the firm for 4 years, and I represent Capital Group's equity and multi-asset strategies.
Hi, I'm Yuzhou Fang from Ping An. I was in the external manager team. We manage a number of hedge fund and mutual fund portfolio for our insurance capital, as well as some third-party clients.
Thank you. Let's start off with a question on everyone's mind, on market outlooks for all the panelists. And so, I mean, we saw, 10 trillion wiped off the markets post-Liberation Day, or as some have called, Obliteration Day. And then we saw a sharp rebound last night. So where do you see equity markets going, and how should investors position themselves today? Maybe I'll start with Ioannis.
So as a systematic manager, we try to find attractive opportunities from bottom-up stock pickers. So we tend to stay away a little bit from macro forecasting, but it is part of the business we are in. There's a lot of geopolitical tension today, and you can see also rising inflation around. So entering the year, we knew that valuations were quite rich, especially in the United States, and we were recommending and adopting a more defensive stance. So what this will test every investor's resolve, but we are thinking that a more low volatility type strategy, or something that is an absolute return strategy that has little beta to the market, is probably the right way to position yourselves in entering this particular year. So even though there's so much uncertainty, this is also going to be a time where we're going to have a lot of opportunities. Like, as things are repricing, we believe that with bottom-up stock picking, some great opportunities are going to arise, and a lot of great businesses could be acquired much more cheaply. So I think a more defensive stance, entering the year and trying to look out for some of these more well-priced opportunities might be the way to go.
So I think it's very hard to make any predictions with respect to the level of uncertainties today, but what is pretty sure is that, at least in the US, inflation is going to trend a bit higher. We are going to have the CPI tonight, so let's see what happens there. It's probable also that we see lower level of consumptions for the consumer and lower level of capex. So we are in a very uncharted environment. And I agree with my mate here, my friend, that the probably well-diversified, well-risk managed defensive strategies maybe is the place to be when it comes to investing in equities nowadays.
Thank you. And Andrew?
Yes, so maybe I'll just start with tariff. So I think somebody has to do that. So I think, tariff announced at this scale and the potential retaliatory actions could really lead to a slowdown in US economic activity. And also, the markets, it's pricing in much higher risk of recession. That, coupled with higher price levels, especially for goods, because of the higher input costs due to tariffs, would also increase the risk of stagflation over the near term. And so if that worst case scenario plays out, and there's a saying that when the US sneezes, the rest of the world catches a cold, then I think global equity market will feel quite a bit of pressure. But I don't think that at this point in time it's necessary for us to literally jump to that conclusion yet. Just now the panelists have been talking about, well, there are negotiations happening between the US and more than 70 nations around the world. So there would be moving parts there. There would be some newer roadmaps for tariffs going forward. And then if we take a step back and just look at the global equity markets at this point in time, yes, earnings growth, it's going through a little bit of a downward revisions, but still at a pretty resilient and healthy levels. Valuations have really dialed back. If you look at S&P 500 forward PE multiples, 18 times. Remember, earlier this year is about 22 times. And so what we're looking at here is, well, taking a longer term view and trying to understand what are the implications of tariffs of individual companies. And also then think about whether there are any price dislocations that we could capitalize. I think is what we're doing, and I think that's what investors should be thinking about. And then last but not least, how should investors be positioned? Going back to your question, 3 dimensions here: core, active, diversified. Core is because the world is changing, so does the investment landscape. We see the more acute oscillations between value and growth leadership. So having that core portfolio gives you a more stable, more repeatable returns with lower volatility and also a little bit more defensiveness. That's what investors want in a time like this. Second, it's core. Second, it's active. I think it's really important to understand companies from a bottom-up standpoint because every single company, even if they're within the same industry, they would go through and navigate tariff scenarios very differently. And so having an active approach makes sense when navigating as investors in this tariff environment. And finally, it's just diversification. I think we've mentioned quite a bit of that, sounding like a broken record, but it's true because we're seeing that market broadening coming through. So having that diversified portfolio, again, gives you a little bit more buffer and also a more appropriate strategy to navigate the volatility.
Thank you. And you, Joe?
Yeah, so I'm not a macroeconomics, but I just look at the history. So in the past, it took the United States 100 years to bring down its effective tariff rate from 20 to 30% to close to 0%. Then the Trump administration want to bring that to the effective tax rate to 20 to 30% in just a few weeks. So my gut feeling tells me that something must go wrong. So it's very likely that U.S. economy will go into recession if that does not change. So what we have seen last night is they decide to post that tariff. But going forward, we still see a lot of uncertainties. The first, whether the 90 days pause will what happen after that 90 days. Second, whether these countries can reach a deal with the United States. Third, the second order or third order effect from the other factors like investors' confidence, the inflation, and other things. So, from an investor's perspective, I think first of all we should avoid concentration. So be diversified. So avoid concentration in any country, any style, any industry, even in any one single asset classes. Second, we can try to pursue absolute return strategies. For example, hedge funds and other absolute strategies or alternatives. The third is that investors should be cautious with leverage, or just do not use any leverage. And last but not least, if the investors can simply consider a barbell strategy in the equity market, so they can balance those high-quality growth stocks with those high-dividend stocks to dampen the market volatility in the short term.
Thank you. I think a lot of the same themes are coming up on positioning, right? Really diversification, having a long-term view, and not trying to time these markets. I wanted to delve a little bit more on something that actually Sam brought up in the last panel. He asked, is it the end of U.S. exceptionalism? So I have a question here for Ioannis, right? I mean, this idea of U.S. exceptionalism has really been the playbook for the last decade, or the idea that the U.S. market is distinctive, has higher returns on equity. What are your thoughts on this, and do you think we are starting to see the unwind of this trade?
It was very interesting to listen, to hear the perspective from the previous panel as well. But the way I think about this is, let's take a long-term perspective back and look what were the key drivers of the U.S. exceptionalism to start with. So you have like 4 things that are at least come to mind. First thing is you have these earnings growth, margin expansion. So that's definitely something that has happened over the last 10 years. Secondly, you had this tech dominance of some big companies. You have a business-friendly policy environment within the United States. And finally, there is an aggressive capital return structure within the managers of companies, with buybacks and all those things. So going forward, how many of these things have changed so we can kind of conclude whether the trade is on and off? So we heard already, earnings revisions are going downwards, so I think that's definitely happening. We see that at least in the tech industry, there's a lot of other emerging players now that are competing from other parts of the world. And there's also some reform happening in other parts of the world, like Europe, Japan, for example, that making it equally or competitive. So I guess my conclusion about this is that the era where the United States is uncontested is probably over. So there's going to be a little bit more competition globally, and that's kind of also goes to how people should position, how investors should position. A more global approach to investing is probably a better way forward, given what's been happening.
Just a follow-up question on that for Andrew. On the U.S. markets, the S&P 500 has become more concentrated over the years. The top 10 stocks today make up about 38% of the market cap versus about 24% historically. What does this mean for investors? And do you think it's a temporary phenomenon?
Yeah, so if we look at the top 10 constituents of S&P 500 index, they're predominantly, there's tech companies, or essentially there's Mac 7 companies that really benefited from the AI exuberance over the last 2 or 3 years. But I would say that there's more to it. There are legitimate reasons why they are Magnificent 7. One of the reasons it's because they are the really small handful of companies in the US that have been going through tremendous earnings growth from end of 2022 to the first quarter of 2024, when the rest of the US markets actually went through an earnings recession. And so these are the companies that have really strong fundamentals, really strong cash flows. And more interestingly, I would say the reason why they get bigger, these big companies become a lot bigger, is because they operate in an industry dynamics where it is winner takes most or winner takes all. But then going back to your question about whether this concentration will continue, I would be a little bit skeptical that it will continue to be in this form. And that's really because if we look at history and taking a longer term view, usually market leadership changes. The top of the market, they don't really stay the same over time as a list. And so back in the 80s, we take a global perspective. It's all about the energy companies. 90s is about the Japanese companies and the top. Going into the 90s, it's the tech companies. 2010s, it's Chinese companies, and then in the recent decade, it's going back to tech again. And so that's a long-term perspective. Shorter-term perspective, we talked about the market broadening, and we are seeing that earnings growth gap between Mac 7 and the rest of the US market narrowing. And therefore, I think these are some of the reasons why I'm skeptical about that concentration would continue to be like that. What does it mean for investors? Going back to being diversified. I'm not saying that we should just write off the Mac 7. I think these are great companies. I think we should keep exposed to them, but size them appropriately. And that's really because you want to make space for other industries, such as industrials, healthcare, utilities, consumer staples, that are seeing really strong earnings growth. And one thing that I want to pick on is dividend. That's not part of the conversation over the last 2 years, but I think investors should bring it back to the conversation because dividend, it's here to stay. And I would say that within the portfolio, think about having those dividend companies there, especially those that are consistently paying out dividends across market cycles, because that informs quality. And those are some of the companies within the US that, as investors, should think about being positioned in.
Thank you, Andrew. Maybe let's shift from the US to let's look at China a little closer. A question for you, Joe, here. With escalating geopolitical tensions globally, it sometimes seems very difficult for investors in China to separate geopolitical risk and capital allocation. So how do you think about geopolitical risk when it comes to investing in China and also just more broadly for allocating capital?
So we all agree that Trump and his administration are very hawkish on China. But it seems that his track record tells a different story. During his first term, between January 2017 and January 2021, the Chinese equity market, represented by MSCI China, outperformed SP 500 by how much? 35%. The onshore CSI 300 outperformed the SP 500 by how much? Also 8%. That calculation already factored in the dividend and the currency effects. So what about this term? We all know that this year Chinese equity outperformed. Even we counting last night's rally, Chinese market still outperformed US market by 12%. The onshore Chinese market outperformed SP 500 by 5%. So what I want to convey is that we should not let the geopolitical headlines to disrupt our asset allocation decisions. These geopolitical headlines could create huge volatility in the short term, but in the long term, it is really the earning growth that drives the return of the stock market. When we look at the earning growth expectations for SP 500 this year and next year, it has been revised down continuously year to date, while the earning growth for Chinese market has been largely stable year to date. So that explains the outperformance of Chinese market this year. So as an allocator, I would say that we really need to focus on those long-term metrics instead of the short-term geopolitical headlines in our asset allocations.
Maybe just a follow-up question on that. Given the difference in performance between Chinese market and US market, as you mentioned, and also escalating trade tensions, how are Chinese institutional investors adjusting their asset allocation during this time?
So in the very short term, we already think that the Chinese institutional investors, including the national teams and mutual funds, has been very actively buying the onshore and offshore stocks recently. Yesterday, we just experienced the southbound inflow into the Hong Kong market, break the historical record. So if we look at the longer term, or more generally speaking, Chinese institutional investors are increasing their equity exposures onshore and offshore, or domestically or overseas, to gain a higher expected returns, because the onshore bond market, the yield is already quite low. And I also suggest that sophisticated Chinese investors to increase their allocation in absolute return strategies, and they can also use cheap investment tools like ETFs to express their views.
Thank you. Perhaps let's zoom out a little bit and look at it from a more global perspective on valuations, right? Warren Buffett, he ended last year with a 300 billion cash pile, and many have now termed that move has like really cemented his title as the greatest investor of all time. And he's famously said, "I will tell you how to be rich. Be fearful when others are greedy, and be greedy when others are fearful." So is it time to be greedy now? How do valuations look, and is it a good time to go in? For Gregoire, sorry. Yeah.
So, is it the time to be greedy? I think it's not an answer. We can say yes or no, definitely as of today. What, on the one hand, we know for sure is that when you have this high level of uncertainty and risk and volatility in the market, and this low level of sentiment and discrepancies, you know that at some point you are going to have a magnificent entry point for risk assets, for US equities, for global equities that will carry away over the next several years. It has been the case in 2020, in 2008, and that's probably going to happen again once more. But at the same time, we are just 5 business days into the crisis. And so if you forget what happened last night, and we don't know how high volatility can go, how low the equity market can go. So maybe it's a bit too soon to be very, very greedy, but we know that the opportunity is going to happen, and so we need to be a bit patient. Maybe the best way to invest is to pace your investments over time, to not being caught in this kind of tremendous volatility that we are seeing as we speak. And just to finish on valuation, yes, valuations are more attractive than they were at the beginning of the year, but we come from a point which for US equities was extremely expensive. So we have seen equity markets going down. We have not yet seen earnings being revised down so much, and that's going to happen for sure, and it's going to happen in the coming days as companies report their Q1 earnings and provide some guidance. So we may see some adjustments in the valuations of companies. So it's more attractive than it was yesterday, but we are not yet at a point where it's a screaming buy for the US equity market.
I think that's also very aligned to how we advise our clients, right? To maybe dollar cost average, to go into the market over time, and not to change their investment plan over kind of like day-to-day market volatility and movement. Yeah, but also looking globally, I have a question here for Andrew. Are there any secular trends globally that you think are not being appreciated enough by investors?
Yes. Well, despite recent scrutiny, I would say that AI, digital disruption, generally speaking, continues to be a secular trend that we think will continue to thrive and drive equity markets. So, yes, I think there is not underappreciation, but I would say a lot more scrutiny around AI infrastructure spending, especially after the DeepSeek moment, and also we're talking about a potential recession around the corner. It's that still going to stick. We think that is the case. And also, if you think about it, right, we talked a lot about tariffs going to increase inflation. Actually, the inflation pressure could create a lot more motivation for companies to invest more in AI going forward because they want to be bringing down their labor costs. They want their, basically, the productions to be a lot more efficient. So I think that's just another perspective to think that, well, even if there is tariff, even if there is an inflation environment that we'll be stepping into, the AI investment cycle will continue to be here. So where I think the market or investors hasn't been really appreciated enough within the complex of AI as a secular trend is actually beneficiaries outside of the AI stack. So one area is that we're finding particular conviction. It's heating, ventilation, air conditioning company within the industrial sectors. And that's really because they are the ones that are crucial in providing the cooling solutions for data centers that are being run 24/7. And so even though they're not part of the AI stack, but they are the ones that will be able to benefit from the AI development and also essentially the data center build out. One more secular trend is healthcare innovation. I think all of us here and also the market generally speaking has appreciated the innovation of GLP-1 drugs. What the market hasn't really looked through yet or focused on is the innovation coming through from genetic drugs development and also medtech that's getting a new lease of life through AI enablement. And so that's also another area that we're looking into. And then finally, that's one thing that I want to bring up. It's less so about secular trends, but I would say a lot of the companies that really benefit from those secular trends that I just highlighted are multinational companies. Now, multinational companies has been under a lot of heat because of tariffs. And I think there is this general perception that, well, domestically oriented companies would be much better positioned to sort of navigate the tariff environment. I don't necessarily subscribe to that view largely because there are quite a number of multinational companies that have been embracing this local for local supply chain model and have been building their capacity and will continue to build their capacity much closer to the end consumers, essentially on the same stretch of soil. And so I think that really helps these multinational companies, we call it the multi-local companies, to fare much better compared to some other companies that really haven't diversified their supply chains. And so that's just another perspective there.
Thank you. I want to delve a little more into the AI theme that you brought up. And this question for Ioannis, right? You know, how has Gen AI, the evolution of machine learning, how has that changed the way that you construct or manage, you know, your equity alternative strategies? And has that changed your quant models?
So AI is a topic, is a theme very close to my heart. Like at Acadian, being a systematic manager, data is the lifeblood of what we do. So we need data. And to be able to efficiently analyze data, we leverage AI across the process. So to give you some examples, you know, cleaning data, feature engineering, the things that we feed into our models, they're very heavily, you know, we use AI very heavily in this process. On top of that, there's specific signals in our models that take unstructured data, for example, a transcript from an earnings call, and we would analyze this using some AI, and then we'll predict whether the earnings call had some positive sentiment. We would do the same things for news headlines. We'll do the same thing for social media headlines. So AI and all these new techniques are used throughout our models. We use deep learning models. We have a specific strategy that is entirely based on using deep learning neural networks. So AI is embedded throughout our process, and we're leaning into it a lot more than we used in the past. I want to say that the portion of our model that uses AI is much larger today than it was 5-10 years ago. The only caveat with AI and the usage of it is it can be dangerous a lot of times because it can lead to overfitting, which means you see patterns in the data that don't have any economic intuition or any financial intuition. So it's very important when we adopt these particular tools at the end of the day to be certain that what we see is a true economic phenomenon rather than some data anomaly in the data.
Thank you. My next question here is for Gregoire. I mean, the themes of sustainability, ESG, is something that our investors are looking at, and we do offer ESG solutions as well. But is this something that Amundi incorporates into your equity investment process? And have you seen a shift in how ESG is being prioritized by investors globally as well as in Asia?
So it's a very interesting questions, and to answer exactly precisely and to give you examples on how ESG matters, I'm going to explain in 1 minute what we do and how we do it. First of all, Amundi is a powerhouse when it comes to ESG. We have invested in people, in system, in data, in innovation, research, developments in ESG for 2 decades now. And it's second thing is that when it comes to our US managed strategies, we have an integrated approach rather than an intended approach. That means that we don't have a specific ESG in the objective of the funds, but it's integrated in the whole process, from the definition of your investment universe, from removing the bad apples from key sectors, from having the data and the research plugged into the portfolio management systems, from even having investment professionals dedicated to ESG sitting within the portfolio management team. And what we care about is the economic materiality of ESG on companies, on share prices. We want to avoid the companies which are exposed significantly to ESG risk, and we want, of course, to overweight the ones which are behave well and should outperform over time. Why it matters even more today is because we know that when we are in challenging market conditions, when you shake the tree, a couple of apples are going to fall. And for instance, that happened in Q1 2023 with rates going up. Few banks in the US went under. And that may, who knows what's going to happen in that current crisis, but the tree will be shaken. Some apples are going to fall. And if you look at financials, I can guarantee that an investment in financial institution with a good governance, for instance, is much more likely to behave well and to fare well than a financial institution with a bad governance. And so I think that it's a very, very long-term theme, first of all, but also it matters even more today to have this ESG angle in the way we look at the financial markets and at companies.
Thank you. I'm going to move on to Q&A now. We have quite a few questions from the audience. The most upvoted question here is for Yuzhou, right? How committed do you think is the Chinese national team in supporting the stock market? And can we expect national team to put in both A and H shares?
So first of all, I would say that my personal guess is that the national team is as committed as China's government's tariff retaliation. So, so they are quite committed. So, and we also know that the head of a PBOC already states that the Chinese government decided to increase their foreign reserve allocation in Hong Kong market. So they will definitely support Hong Kong market.
Thank you. I think it's a relief to hear from the audience. They're very committed.
Personally.
Personally, yes. There's an interesting comment here on diversification. So diversification is a cliche. How should investors actually rebalance their portfolios in view of the prevailing trade war and possible recession ahead? Maybe I'll open that up to the panelists, whoever wants to answer that.
If I may jump in, I think it's very interesting because over the last few days, and I was looking at the data as of yesterday, so it's maybe changed last night, but global equities were down 10 on the months, US equity were down 10, value was down 10, growth was down 10, Magnificent 7 was down 10, so everything was down 10. So the diversification didn't work over the last few days. On the other hand, we saw a lot of cyclicals versus defensive moved a lot, so financials, energy was truly impacted very, very badly, and some like utilities, consumer staples outperform. So on the short-term diversification, it's not working very well, but on the long end, it makes a lot of sense to have different assets in your portfolio across sectors, across regions, across asset classes, and to rebalance them when the valuations are shifting.
A question, so we've touched a lot on global markets, US, China. We have a question here on India. What are your views on the India market? And in terms of diversification, how does that sit as well? You want to take a crack on this one?
I think India was, if you look back, when I was very excited about the Indian equity market 6 to 9 months ago. Actually, it was very expensive, and China was very, very cheap at that time, and it has normalized a bit. So we see the valuation gap between China and Indian equities, which has, in the same kind of regions, and can do some parallel here. I think we are in a much more normal environment where the discrepancies in terms of valuations have collapsed a bit, and so both countries looks appealing in terms of valuations. Not evenly, but almost. It was not the case 1 year ago.
Yeah, I would say that, if I look at India, what we've seen over the last couple of years is that the reforms has taken place has really changed the fabric of the economy. So a lot of the reforms is to bring the urban populations into the financial system, into the capital system, and that really helped a lot of the credit growth, loan growth, and a lot of the banks has really benefited from that. And then I think the other reforms is on infrastructure. So historically, there's always this bottleneck in infrastructure that really rein in the economic growth potential for India. And I think the government has done a lot in addressing that. So by essentially alleviating those bottlenecks, we've seen infrastructure coming back. And the fiscal investment on enhancing different forms of infrastructure in India has also sort of just give some fresh air into India's economy. And so if you think about just different areas for investing in India, not just in banks, now we're talking a little bit more about, for instance, telcos, for instance, on the consumer side. But then I think ultimately it's still important to think about, from bottom-up active standpoint. So not just in India, but going back to your earlier question about, just how do you think about diversification, in your portfolio? Obviously, this is an equity panel. We have esteemed colleagues from the fixed income side that's going to talk about the fixed income. But I think, fixed income also plays a role, and we've seen that negative correlation, especially in a high-quality spectrum of fixed income, have a different return profile compared to equities year to date. And so I think fixed income definitely has a role to play in diversification, plus other private assets. And then specifically on equities, it's really about thinking, where are the less concentrated part of the market? Where are the markets that we think that have more defensive qualities, that have a little bit more of the attributes that's negatively correlated to, the Max 7 or, again, those last 2 years, the momentum trades. I think that's how we or investors should think about when approaching diversification within an equity block in your portfolio.
Thank you. I'd like to end on a quick fire question for all of our panelists today. 30 seconds each. What keeps you up at night? What is the biggest risk to the outlook that you mentioned at the start? Start with Ioannis.
Well, being very much model-driven, I think misestimating or being able to react fast enough to what's happening around us is what keeps me up at night. And being able to have a very much risk-managed portfolio that kind of reacts dynamically to what's happening, that's really my biggest challenge, what keeps me up at night these days.
For me, I think what keeps me up at night right now is fixed income markets, when you have treasury yields going up over the last couple of days, and at the same time credit spreads widening as well. If it goes too high, too fast, and it stays at this high levels for too long, the machine breaks. Corporates can't issue debt, and becomes a huge problem for financial markets. So I think we need to pay a lot of attention to this, because we can live in a world where equities are volatile and down, but the fixed income markets matters a lot in our environment.
I started with tariffs. I'm going to end with tariffs. I think tariffs definitely something that's keeping me up at night. But here at Capital Group, essentially, we have 477 investment professionals across the world, and that gives me some comfort. So I could actually go to bed because then, just people around the clock sort of understand, what is the impact to individual companies. But if I can just say one more thing, I think what's been keeping a lot of investors up at night, it's thinking about how to tinker a portfolio, how to think about how to time the market. We talked a lot about the importance of time in the market, not timing the market. And just one perspective, if we look back at the last 10 years, and if you miss just 10 best trading days, and usually those 10 best trading days happen around the most volatile times, your cumulative investment during the last 10 years would see a 45% loss in value. And so, again, that just goes to the merit of time in the market, not time in the market.
We love to show that statistic to our clients. I'm glad you brought it up.
So my answer is that the short answer is Chong. That causes a daily volatility. So in the medium term, it's China's consumption stimulus, how it will play out. But for the very longer term, I have questions on the credibility of the US dollar and the US treasuries, since we manage the overseas assets for Chinese institutions.
Okay. With that, we'll end our panel. Thank you so much for our panelists for joining us today.